Hi, everyone. Welcome to the Capital Raiser Show, Season 5, powered by the Family Office Club. I'm your new host, Weston Walker, and we interview only the best investment managers and entrepreneurs. Shout out to our sponsors, the Family Office Club, Capitalist Pro, and Invest Next. Today we have Dusten Hendrickson, CEO of Mailbox Money Real Estate, and they are solving the affordable housing crisis. Dustin, welcome to the show.
Hey, thanks for having me, Weston. I really appreciate it.
Of course. Yeah, so can you go into your background? You mentioned you're a multifamily syndicator. You've been syndicating deals across the country. So tell us about your background and how you got started.
Well, I got started about little over 20 years ago. I was actually I had a roofing company, and then I found myself wandering through the interiors of the houses and liking the design and the flow of the homes a lot. So then my mom approached me and said, "Hey, I want to build a duplex or a rental property." So I said, "Yeah, I'll build it. We'll use your credentials, your finance background, and your credit score." And so we bought a lot and we started and we screwed everything up, and had to redo most of it. And we learned a lot. And then we kept going and kept going. And then we learned that the more units, the more units we did, the better the project was. So we found syndication in about 2018, and we did a lot of value add stuff. And then I found myself I was always asking myself, like, these deals are just not that great. They're not in great locations. They're old. People don't really want to live in them. And they, after that, the initial, when it first started, people were okay paying for the upgraded unit. But then the more time went by, the more people realized it's kind of lipstick on a pig. And the everyone really wants to live in new construction. So I pivoted and I just was, I told myself, hey, these are great assets, but we can do much better. We can develop for the same price that we're buying this stuff for. And there's everyone says that immediate distribution, but that's not really that true unless you find a really discounted off market deal. They're usually raising additional funds for the immediate distribution. You have to create value somehow to get those distributions. And so waiting a year for a development or 2 years to kick off cash for development is similar to waiting a year for a value add. And we just went farther and farther into it. We did a bunch of A class, some B and A minus, B plus, and then we realized that our niche is B class, and we really like the way we can operate it. It's more passive for us. A class stuff, there's a lot more maintenance. The expense ratios are higher, and we are finding we weren't getting our ROI out of a lot of the amenities, and so now we're focusing on, it's a modern workforce model, is what I call it, modern workforce housing, and it's workforce structure with an A class interior, and then we put them together. So then we have super nice interiors in really safe suburban locations.
Awesome. Yeah, and tell us about the different markets you invest in. You said B class and you add value to the properties. What markets do you invest in and why do you choose those markets?
We've invested in all the southeastern markets, Texas, Phoenix, through the Midwest. Most of my investments are actually in eastern South Dakota, primarily Sioux Falls. That's the biggest city, and they kind of radiate out. Um, I found that these boom markets, like, there's a lot of boom markets that we'd go to them. We did well for a little while, and then now the returns are kind of trailing off in a lot of those markets, and they're being, there's a lot of negative returns. There's a lot of equity being lost right now because everything's kind of going downhill. And I know that in my area, where I'm familiar with, the Sioux Falls region, eastern South Dakota, it's very, very stable. You rarely go backwards on a project. And so I prefer the very steady growth that's always there over the boom and bust. You have to time the markets really well, or else put long-term debt on the projects, and then the long-term debt kind of handcuffs you. So we kind of do a mixture of a little bit longer term. We do about 5-year loans on, usually with very low prepayment penalties, and that allows us a lot of flexibility. And then if it's an asset we want to keep long term, then we throw some agency debt on it. But we like to be flexible, and then at the same time, we don't like a short term bridge loan.
Mm-hmm. Got it. And are you guys the lead GPs? Because you mentioned you're in the Southeast markets and markets across the Midwest and Sioux Falls. Are you guys just the lead GP in Sioux Falls? Because I know that's where you're from and where you have expertise in. Um, it's hard because if you invest out of state, usually the operators need boots on the ground in those markets. So
Yeah.
how are your deals structured?
I'm usually a co-GP on all those other investments. So
Got it.
I'm very involved, and I'm more involved on the design side. So I'm a lot more involved in the assets in South Dakota because development is where I provide the most value. And on the value adds, there's just not that much design that's really needed. There's not that much development experience that's really needed. So the operations guy takes the majority of the asset. And so I'm more of a co-GP on the value add stuff that's in the other parts of the country, mainly the South and Southeast.
Okay, and then how do you choose which operators to partner with for the co-GP model?
Um, I actually partnered with quite a few at first when I first started, and now I've narrowed that down to one. I only partner with Boardwalk Wealth now
Hmm.
as a co-GP on those other deals.
Gotcha. And then what drove you to that decision? Like, why do you choose? I mean, you've worked with several operators. What was your due diligence process, and how did you choose to only partner with them?
My due diligence process was put my own money in and see how they worked. Um, Due diligence to me without doing the project is very hard. Once I put my own money, I'm much more invested, and then I do a lot more due diligence. So it's easier for me to do a lot of due diligence and a deeper dive once I put money with someone. So I invested with a bunch of people, and I only brought capital into two other GP funds, but the majority of the capital I bring in is for Boardwalk Wealth.
Gotcha. And then, what are the deals you guys are currently doing? I'm assuming, do you guys do 506B, 506C deals? Just tell us what deals you're currently doing.
We're doing 506C deals, 506B deals. We determined that most people that have enough money to invest 50K into an investment are accredited. And
Hmm.
it was only about 3% of our investors were not accredited. And then there's more liability with a 506B. A lot of people don't really understand, but a sophisticated investor is much, you're they can claim that they didn't know what was going on a lot easier. There's usually more lawsuits from a 506B investor than a 506C. Once they're accredited, they take more of the liability on. So and then also you can be scrutinized with if you actually did any public advertising or not. So there's just a few more rules to abide by. Um, and so that's the main reason why we do 506C. It is a complete pain to collect accreditation letters, though.
Hmm.
That's the biggest reason why we would entertain a 506C or a 506B over a 506C, but we've just grinded through it and got the accreditation letters somehow.
That's interesting because I've heard of some accredited investors backing out due to the 506C.
Oh yeah.
It's crazy. So,
Yeah.
yeah, you guys do multifamily. What differentiates you? Because there's a lot of multifamily syndicators out there. So what makes you guys unique?
The development aspect. I honestly am not investing in any value add right now. Um, Unless someone dumps it in my lap, and it's an insane deal that I can't pass up. I don't think any on market value add is that valuable right now. Anything that goes to market with the dynamics of the market, you're going to pay top dollar for it, and you're going to get very very little return. It, for a value add to work, you have to have an off market deal, and you have to have had sourced it through your own networks. If someone else is bringing it to you, they're going to bring it to other people and try to get top dollar. So if you're picking up the phone and calling mom and pops, that's literally the only way you're really going to get a good off market deal. Now, if a law firm or a bank knows you and they want you to operate it and they bring it to you, that's another way. But that's basically a fall in your lap type deal. Those are the only ones that I would invest in. I just don't think that there's very much value there. And so that's kind of where that's kind of my standpoint. I do think there was so much value created from, or that was on the table from the about 2010 to 2022. It's uh it's pretty remarkable because the it was so suppressed. The market was so suppressed in from 2008, and there was units selling for $10,000 a unit, and then, you know, 10 years later they're selling for 200K. And so I think people still have that mindset in their head that it's going to be that good, and I don't think that there's really that much cash to suck out of the real estate market. And the only way you're going to
Hmm.
do it is if you give someone a lot less money than their property is worth. So because that was never I've been doing this for 20 years, and that before the '08 crisis, we ran into the same thing where like everything's too expensive to buy. We have to develop. So that's why we started developing. We couldn't even afford to buy because nothing would cash flow. And so it would cash flow if we developed. Then when the crisis came, you could buy some assets. But then it pushed up so high, and then with the low interest rates, it kept going. But now we're at a position where interest rates are normalized. The value is as high as it can get, and it's probably a 5%. You're going to make about 5 to 10% now on market assets. So how do you provide more value? And most of the value add has already been done because the syndication model got wildly popular. Most apartments have been flipped. There's not that many that are old, crappy units that can be flipped. And then the other thing is there's lots of units that have no business being flipped. So a lot of times people flip the unit, put a bunch of money into it, and are getting almost the same amount of rents before they did the uplift. So I've seen a lot of that happen. And I just see so many syndicators now are in trouble across the board. All the 2022 assets, those guys are in big trouble. And I see it. It's not really out in the public yet, but I hear the grumblings and I see everything, and I'm seeing some of these DSCRs, and most of these guys are under one DSCR, and they've been under one for 2.5, 3 years since the interest rate spiked.
Totally. Yeah, and how are you guys taking advantage of maybe those troubled deals that the operators can't handle, they're foreclosing, or they're, the equity's getting wiped out of those deals?
Well, a few select ones we can take over, um, but you have to know people that are already working on the deals. If you don't have relationships with someone that's working in the deals, like a relationship with the bank or the law firm or even the syndicator is usually not much help. They're the syndicators are walking away. There's no money to be made. So there was a term back in the '80s during the savings and loan crisis. It was called sad GPs. They were sad GPs because they knew they were never going to make any money, and they were just trying to kick the can down the road, and eventually with zero motivation to improve the asset, because no matter what they did, they were going to lose all the money regardless. Then they turned into sad GPs and they just neglected. And so we are now seeing the same thing. We're seeing sad GPs. And so that's how you can take advantage. But a lot of times the GPs are so sad they've neglected the asset. It's not even worth the debt. It's not even worth the paper's not even worth the debt amount. So now you have to go in and negotiate all that down too.
Yeah, and then how do you go about raising capital? Is that from individuals, institutions?
We raise capital from everybody. So friends and family, individuals, retail investors, family offices, RIAs, institutional. And so we will put our retail investors in a certain segment, like we'll raise this one to retail. And then if a big check writer comes by, we'll just give them the whole deal. And then if institutional equity comes in, we'll start a fund and put everything in a fund, and then they put their money into the fund. So we have different ways of doing it. And we're developing a deal roughly every 2 to 3 months, and we're going to ramp that up to a new deal every 3 to 4 weeks. So we have lots of different ways of raising money. We're also with our affordable housing. initiative, the Modern Workforce Housing Initiative that we're doing to solve the affordable housing crisis. We're going into smaller markets and we're contacting economic development corporations and municipalities that have some say over that. And they usually have land designated. So they'll say, hey, we'll sell you this land for however many dollars a foot, and then we'll give you a TIF to improve the land. So the land's pretty much free because the TIF pays for it or pays for the infrastructure. Sometimes the TIF will pay for the land and the infrastructure. Then we go to key stakeholders in the community and they will put the money in for the equity needed for the project. Then a local bank will complete the lending. So there's also that method that you can do if you have a project that the city really wants you to do. But that's the key. Like the city has to fall in love with your project.
Yeah, totally. Yeah, so a lot of our listeners are GPs that raise money from individuals. What are your top strategies from raising from high net worth individuals?
And it seems like it changes all the time. Like you think you figured out something like, oh, cold texting is working great. 3 months later, that doesn't work anymore. Cold email, this is working great. We're going to build all these funnels. That doesn't work. Meta ads, Google ads. So we really work on our marketing a lot, but honestly, picking up the phone and calling is still by far the most powerful tool. And then getting referrals from your investors. So communication with all your current investors is massive, and you have to love the deal. So if you love the deal and you're really into it and you can spread enthusiasm through the phone or through a meeting, you're going to get more investors. Then you got to perform, and then when you perform, you can get referrals from those investors. But in my opinion, it's hard work. And 2 years ago, we could send out an email and fill up a deal in a couple weeks. Those days feel like they're gone. Maybe they're not gone forever, but right now they're gone. And some people can still do it if they have an army of co-GPs, because each co-GP has access to a few 100,000 or a few million, and they can bring in the deal and fill it up in a few days. But you have to have a massive network, and then you usually have to have a lot of history behind you. But if you don't have that, picking up the phone works. That always works. So anytime that we're under the deadline, under the crunch, and we need to raise money, we've always found that picking up the phone and calling everyone we know and saying, okay, if you don't want to invest, do you know anyone that does want to invest? This is, if you got to love the project though too, because people can tell. So if you're not really into real estate, it's hard to sell. And I just think it's going to be really hard to do that method. But I think it always comes down to it. You have to build a relationship with someone. Once in a while, someone will invest with no relationship with you. But what I see is if you do have an army of co-GPs, someone has a relationship with the co-GP, and that co-GP can then leverage your expertise. But to me, it's all relationship based. And we've been doing a lot of different ways. And the majority of equity is secured once we educate them on our product and once we build up some trust with them. So it's the same: know you, like you, trust you, and then invest with you. That whole top-down pyramid type thing. And what I found is it's the same with everybody. It's just how they get to that point is different. Maybe people use a little different methods. And so the best luck I've had is always calling. So if our methods are not working, just pick up the phone and we can figure out how to fill up the deal.
Yeah, and a lot of the know, like, and trust part comes through social media as well. I see you on LinkedIn. Do you guys have a social media strategy? Like, do you get a lot of investor leads through social media?
Yeah. So we get tons of leads, but we have to really nurture those leads. We have to really communicate those leads. We invite those leads to things. We offer those leads gifts. Not corny gift, like just, hey, we got this going on. Would you like to come? And a lot of people are like, oh no, I live down here in Texas. I can't come to that. But just offering people something is just as powerful as giving them something. So, and it's an easy way to add value. Anytime you can add value to somebody without asking for a sale, I feel works best. And not selling and educating first, just educate, and eventually they'll ask for the sale. But one thing that I've learned recently is you need to create sales meetings. How do you create sales meetings? Because if you create enough sales meetings, you'll eventually get the sales. So the goal is always to create the sales meeting. And a social media post is not necessarily a sales, that's not a sales meeting, right? That's just figuring out how to get the lead. How do you get that person on the phone? And a lot of times just getting them on the phone is the first sale. You've created a sale because you got them on the phone to the sales meeting. Then you don't sell them anything. You just try to get them on another call, try to get them on another call, try to get them on another call until they ask you for a sale. And that's, to me, that's a really good method, is to keep getting sales meetings and just educate.
Yeah, and that's the whole relationship aspect of it as well. You mentioned education. What educational resources do you provide for your investors?
Oh, we just educate them on our process and why we do what we do. And if there's maybe a cool article, we can attach that, or we educate them on the current state of the market, like um, the permits, right? So building permits have been dropping off the last 3 years, but there is tons of permits in 2022 because interest was so low. So all these multifamily permits now are coming online. So the market seems super soft, but it's a temporary problem because if you look at the data, it shows that we're pretty much at the bottom and now we're starting to climb out. And some cities are already starting to climb out, like Minneapolis. Other cities like Austin are just starting to hit the saturation point. So all these cities, for the most part, every city is kind of in the same boat. Tons and tons of free money, so tons of stuff got built, and so there's saturation happening now. Who's going to absorb it the quickest? The Northeast doesn't really have the problem because there's so much red tape that's so hard to build. Not as much stuff got started there, and they had negative migration, and then they had migration back now, so people weren't really building in that area. But other than that area, almost the entire nation is dealing with the same issue of saturation.
Totally. Yeah, and what are the best buying opportunities you're seeing currently?
Man, I'm not seeing any good buying opportunities yet, even. Um, Once in a while, you'll see a deal that comes up that's a little bit distressed, or that if somebody does want to sell, um, it's an all right deal. I would say though, I would buy newer assets. I would not buy these older 70s vintage, 80s vintage. They're almost at the end of their life cycle. We have a lot more trouble renting those. We have a lot more trouble renting the older stuff. People don't really like the design. They end up moving out. It's not as comfortable. It's noisy. It's People don't like living in old stuff, and the newer design of stuff is making it feel even more dated faster. And so much new stuff's coming online at just a little bit more for rent than the old stuff. So I'd say stay away from old assets and buy, if you're going to buy something, buy the newer built stuff. The maintenance is way lower on it. The utilities are lower. Um, if you can buy smaller assets right now, there's a little bit of a deal on them, I guess. So if you can pivot into some smaller stuff, but it feels like there's not really many deals to be had. People are still trying to hold on. But yeah, maybe go and try to figure out who's distressed and see if you can get in there.
For sure. Yeah, and what are you guys' plans for the future?
We are building a pipeline. We're building pipelines in about 5 different cities. We're going to go to Rochester, Minnesota, Madison, Wisconsin, Des Moines, Iowa, Overland Park area of Kansas City, somewhere in that area, and then um, Columbus, Ohio. That we're going to go there first. Then we want to go nationwide, and we need to partner with a lot of people, or we need to franchise. We have a really good affordable housing plan that works in almost any community, any suburban community. Uh, we like to put them close to urban cores, but they don't need to be. You can put them in a community that has growth, and if you have some key stakeholders that are willing to invest in the project because they, like, say this business needs housing for their workers and this business needs housing and they need housing for workforce, you can put this thing anywhere because local banks they usually have a mandate to lend, or credit unions. to lend to that stuff. So they'll lend to it. You get your local people to invest, and it'll fill up. They're so desirable, they pull people from all the other units, and the rents are 900 to 1,500 bucks a month because of the way we design them.
Interesting. Yes, Dustin, I appreciate you coming on the show, giving your advice. How can people get in touch with you, whether that's Mailbox Money, yourself, they want to invest or partner with you, etc.?
Mailboxmoneyre.com is the website. You can get a hold of anybody through that website and send me an email. Send anyone else that works with me an email. Hit me up on LinkedIn. We've got people watching all this stuff. So if you said, hey, I want to co-GP with you on some of your deals, it'll get through. If you say, hey, I want some advice on this real estate deal, it's going to get through. I love to mentor people. So if people just want to ask how to get started co-GPing and they don't even want to co-GP with me, I can help them out. I can steer them some way. But yeah, I believe in that if I help somebody, so if someone needs help and they reach out to me, I help them, someone's going to also then help me. So that's also a way that I do raise capital. I help solve other people's problems and the money just finds me somehow. So, and it's one of my favorite things to do is to mentor anybody, but we're always looking for partners and co-GPs, capital partners, different, if people want to bring this affordable housing to their community, they think they need it, we can help them get started. Like I'm fine giving away all the information. It's not a big deal to me. I'll share all this information so that they can help their community as well, because we know we can't build everywhere, and most of the nation is not our competition.
Sure. Yeah, it's always great to provide value first. So thank you, Dustin, for coming on, and looking forward to possibly having you back on in the future.
Fantastic. Thanks a lot, Weston. You asked some great questions. Plus, you got a really cool booth there.
Oh, thank you. Appreciate it. Have a good one, Dustin.
You too. Thanks.